The topic in this video lesson is failed signals. Now, we label a failed signal as anything that entices traders to enter into a position due to the assumption that a break in price action has occurred or is about to occur. But then, to their dismay, price action almost immediately reverses. In other words, failed signals are any attempts at a breakout or breakdown. Remember, from earlier videos, breakouts indicate that a stock has broken through resistance and is making a bullish move up in price, while a breakdown indicates that a stock has broken through support and is making a bearish move down in price. Okay, so how do traders get lured into these failed signals? Well, often very large size plants on the limit book or ECNs at key technical levels. These orders tend to act similar to a magnet, as price action drifts to the large order to test its validity, and in turn provides traders with valuable insight on the current strength or weakness of the stock. Now, due to the large size of the limit order and the location of it being at a technical level, it takes time to muster up enough orders to eliminate the one large limit order. Thus, a large level forms, creating a potent barrier. Moreover, when the large limit order creating the level of support or resistance is broken through, typically a flood of orders come in, thus causing quick prints on the tape and a dramatic move in price. Now, keep in mind that these levels can form on moving averages, technical patterns, trend lines, just as easily as the typical horizontal support or resistance level. Okay, so what does all of this have to do with failed signals? Well, when the flood of orders cannot create enough momentum to carry a stock through a level, price action reverses, causing the trend to change direction. Take a look at this chart of Ann Taylor, ticker symbol ANN, to get a better idea of what a failed signal typically looks like. Notice how the resistance level at $33 was broken through as a large seller of 20,000 shares was eliminated, rising the stock 12 cents in just seconds. But almost immediately thereafter, the price falls right back below the previous level, and now the stock price starts to head downward. These failed signals can create headaches and substantial losses for traders, as they often get caught off guard by the failed break. While there is no way to be 100% certain whether a breakout or breakdown will be a successful one, there are ways to determine whether the break has a high or low probability of working. Here are some questions that you should be asking prior to entering into a breakout or breakdown to avoid getting trapped into a failed signal. Is this the first time the level has been tested, or has it been tested numerous times? How aggressive have the buyers or sellers been up to this point? Is this level the only level within sight, or are there other potential levels very close by? And what is the trend of the overall market, and how aggressive is it? Okay, if you're already in on a trade, what are some signs that the move is failing? We will use a breakout for our example. For a breakdown, simply invert the signs. The following signals are of a breakout that is potentially failing. 1. There are continuous prints on the bid rather than the offer. 2. There is a sudden lack in interest to buy from other traders. 3. There is only a single spike in price action caused by one large print, referred to as an exhaustion print, followed by no other buying pressure. And 4, the overall market momentum heads downward. So what should you do if you notice that the move is failing on you? 1, exit your position immediately. Do not wait to be stopped out of your position. 2, look for a possible reversal opportunity, but keep in mind that with the previous level broken, it is now no longer a viable source of protection. And 3, consider re-entering the stock if it retests the later again with more conviction. I personally like to use a 3 times then I'm out rule when attempting to enter into a break that has failed on me. After my 3rd unsuccessful attempt participating in the stock in either direction, I cut ties with the stock for the day and move on to greener pastures. Now let's take a look at 2 examples of failed signals. In these examples, you will see 2 distinct types of failed signals. One that attempts to break but fails, and another that actually breaks but also fails. In this first example, we see General Mills, ticker symbol GIS, at a level created by a large sell limit order of 77,900 shares, placed on the CINEX, which is an ECN. This large limit order, coupled with all of the other sellers at $71, forms a potent barrier of resistance. Moreover, at this current point in time, the overall market, which can be seen on the chart in the bottom left-hand corner, is near its high for the day. A trader looking at this snapshot thus sees one of 2 options: either buy the stock should a breakout occur, or short the stock, hoping that the resistance level at $71 holds. Now, remember, the stock is up $1.50 on the day, and the market is up significantly as well at this point. Therefore, it is easy to see why most traders would attempt to go long. As a result, many traders quickly pile into this stock at $71, but ultimately are only able to eliminate a little over half of the large sell limit order present. This inability to completely remove the large limit sell order obviously causes traders to doubt the true strength of the stock. By looking at the next slide, we see that this inability to break causes buyers to give up on the stock and head for the exits. With all of these buyers exiting their positions, the stock reverses trend and begins moving downward. Moreover, by looking at the overall market in the bottom left-hand corner, we see that it too began to fall at relatively the same time, thus aiding in the significant downturn of the stock. Now, this is not your standard failed signal, in that the large limit order that created the level successfully held, causing trend to eventually reverse. Even though a break never actually occurred, we consider this a failed signal because many buyers were lured into entering the stock as they assumed that a break of the level was imminent due to the speed in which the buyers were eliminating the large sell limit order. That buying pressure created a buy signal to many traders, causing them to enter. However, once they realized a breakout was most likely not going to occur, especially with the market heading south, they all sold their positions. Now, unlike with the example we're about to see, this type of failed signal can easily be avoided by simply waiting for the stock to officially print a price higher than the level, indicating that the seller has been successfully eliminated. Obviously, by waiting for a break, you forego the great entry point and instead must chase a little to enter. But you do in turn avoid entering prematurely. So there is definitely a little give and take in this situation. Moreover, unlike with this next example we're about to see, there is an opportunity to profit should you recognize the likelihood of the level holding, as shorts that enter in front of the large seller would have never been stopped out of their positions, as the price never touched $70.01 or higher. Okay, moving on to this next example, this one being a much more traditional failed signal, in that this level is actually broken through before it suddenly retraces and moves in the opposite direction shortly thereafter. In this example, we see General Mills, ticker symbol GIS, on another trading day than the previous example we just saw. On this trading day, we see General Mills open down over $4 on weak earnings and continue downward as the 20-weighted moving average acts as resistance. By taking a look at this next slide, we see that buyers come in and manage to break the stock through the moving average, indicating strength, as this is a possible reversal in trend. However, the move does not last long, as the initial surge ends up being the high of the move, as the price action pushes the stock back down once again below its average, indicating weakness and confirming that the breakout has failed. This type of failed signal is usually the most frustrating for traders, as both those who were long and those who were short are forced out of their positions. Ultimately, a successful trader is always prepared should a breakout or breakdown fail on them. Losses can add up quickly if a physical stop, or at least a mental stop loss, is not put in place, as failed signals occur quickly and dramatically. Always stick to your original predetermined exit and do not push your exit price back in order to stay in the position. Failed signals destroy traders with money management and discipline issues. If a move fails on you, do not get frustrated. Accept the loss and move on. Failed signals are a part of trading. While there are ways to avoid getting lured into some of them, inevitably, a failed signal can happen during almost any break. Therefore, in order to be successful, it is crucial to have a game plan and stick to it.